All right, let's break down the upcoming IPO for a really interesting EdTech company, Excelsoft Technology. We're going to look at what they do, dive into their financials, uncover the big risks, and see what the experts think. Right now, the IPO market in India is absolutely buzzing. Just last year, 79 different companies went public, and most of them listed at a premium. That tells you investor confidence is sky high. And now, Excelsoft is stepping right into that very same spotlight. So that leads us to the million-dollar question we're tackling here. Does this company, playing in the booming world of education tech, actually have what it takes to become a major success story? Okay, so first things first, let's get right into what exactly Excelsoft does. And it's not just another generic tech company. They have a very, very specific focus. They operate in a space called vertical SaaS. Now, the easiest way to think about this is instead of making a one-size-fits-all product for everybody, they build highly specialized software just for the education and assessment industry. So their tools are custom-built to solve the unique problems that universities, publishers, and testing centers face every day. And their whole product line is designed to cover the entire journey of digital learning. It really starts with creating content on their publishing platforms. That content then gets used in their learning management systems. From there, you've got their SaaS platform, which is for conducting these really important high-stakes online exams. And to make sure those exams are secure, they have an AI proctoring tool that watches for cheating. It's pretty much the whole shebang, a complete ecosystem for learning. And this isn't just a local operation, not by a long shot. They are global. As you can see, they're working with 76 clients in 19 different countries. They've got a serious international footprint, and they count major players like the Pearson education group as clients who rely on their tech for huge, large-scale exams. So a specialized business model is great, but how does that actually translate into dollars and cents? Because let's be honest, a great product is one thing, but for it to be a great investment, the numbers have to back it up. So what is the story these numbers are really telling us? Now, this is where it gets really interesting. Take a look at the revenue. It's showing some nice, steady, healthy growth. That's what you want to see. But then you look at the net profit. After a bit of a dip in fiscal year 24, it just completely exploded this past year. And when I say exploded, I mean a jump of 172%. Yeah, a turnaround that dramatic, that's the kind of number that makes investors sit up and pay very close attention. With a number like that, you might think the story is perfect, but every investment has a but. And for this one, we really need to look at what's hiding in the fine print. So we have to ask, what are the red flags here? Because underneath that incredible profit growth, there are two pretty significant risks that you absolutely have to consider before jumping in. And here is the first major red flag, and it is a big one: client concentration. In the last financial year, almost 60% of the company's entire revenue came from one single customer, the Pearson Education Group. That's a classic risk, creating a massive dependency on just one business relationship. And hey, don't just take my word for it. The company says it themselves right in their own filings. They flat out acknowledge that if they were to lose a major customer, it could seriously hurt their financial performance. When you're that reliant on one client, any change in that relationship is a huge threat. The second red flag is another big number, one that definitely needs a closer look. That 300 crore rupees represents a corporate guarantee. So what does that mean in plain English? Think of it like this. The company has co-signed a massive loan for its promoter. If the promoter can't pay back that debt, guess who's legally on the hook for the whole amount? Excelsoft. And because this guarantee is worth nearly 80% of the company's entire net worth, a default could literally wipe out most of the company's value overnight. Okay, so that gives us a pretty complex picture, right? We've got incredible profit growth on one side, but these very high-stakes risks on the other. So how is the market actually pricing this thing? Well, a key way we measure this is the price-to-earnings ratio, or PE. At the top end of its IPO price, Excelsoft is being valued at about 35 times its yearly earnings. Now, is that cheap? Is it expensive? Well, you can't just look at that number in a vacuum. You have to compare it to its peers. And when you put its valuation side by side with other specialized tech companies, that PE of around 35 times, it looks pretty much in line. It's not a bargain, for sure, but it's not wildly expensive either. Most analysts are calling this a fair valuation, given its business and its growth. And this mix of strong growth but serious risk has, not surprisingly, led to a split verdict from the experts. On one hand, you've got a brokerage like Reliance Securities, giving it a subscribe rating. They're focusing on the company's deep expertise and its future potential with AI. But on the other side, SBI Securities has a neutral view, basically saying the valuation is already fair, which might not leave a lot of immediate upside for investors. So that's really the bottom line here. Excelsoft is a compelling high-growth story in a really hot sector, but it comes bundled with two very significant, very high-stakes risks. For any potential investor, the crucial question they've got to answer for themselves is pretty simple. Is the potential reward here actually worth taking on that risk?